the 2020s are likely to be volatile and challenging for investors, the best thing that I can do is encourage people to take an interest in the markets themselves, to get a sense of their own risk tolerance, and to have a sense of some of the key factors that are affecting their investments, including interest rates and so on. Once again, as I said earlier, that's certainly critical if they're attempting to manage their own finances. But it's also important, if they're lucky enough to find a good advisor, that it's always a good idea to know enough about something to be able to ask intelligent questions so you can understand what's going on. It's like with our health, right? I mean, we all have physicians, but frankly, it's a good idea also to know about some key issues affecting our health, that we can ask our doctors, intelligent questions so that we know what's going on and the state of our health. So my encouragement would be to learn as much as you can. I think it will be time that's well rewarded, not only in terms of potentially financially, but just in sort of generating a bit of a peace of mind by having an idea of what's happening. And certainly, that's part of the mission of the Global Investment Letter, is just to provide a perspective for the subscribers to make their own investment decisions.
My guest today is Jonathan Baird. Jonathan has managed 3 number 1 ranked mutual funds throughout his career, and most recently won a Lipper Award for the top global equity fund in Canada in 2010. In recent years, Jonathan has been publishing the compelling and impressive Global Investment Letter, which covers major equity, bond, currency, and commodity markets. After reading a couple of his issues prior to this recording, I knew I was in for a treat, as Jonathan has a wonderfully thought-out perspective on global markets. We get into his approach to investing, inflation, the economy, and his expectations for markets going forward. We talk a lot about the psychology of markets and how crowd behavior can affect them. This one you won't want to miss, so let's get going. Here's my conversation with Jonathan Baird.
Welcome to the Invest Smarter podcast, where we'll simplify investing and provide actionable ideas to help you navigate the markets and own your future. From retirement planning strategies in plain English to timeless investing wisdom, we'll cut through the noise and leave you a smarter investor by the end of every show. All content within the podcast is for informational purposes only and should not be relied upon for investment decision making.
Jonathan Baird, welcome to the Invest Smarter podcast. It's great to have you here. I can't wait to talk about all things markets.
My pleasure.
Excellent. So your background, I noticed you have an impressive track record, especially when it comes to winning an award, and in Canada, the Lipper Award, correct? So I'd like to hear a little bit about your investment philosophy and how you were able to maintain consistency.
Yeah, thanks. I did win the Lipper Award in 2010 for having the number 1 global equity fund in Canada. And I had run previously a couple of other number 1 ranked mutual funds. Most of my money management career dealt with mutual funds. And since that time, I have concentrated on just managing my own account in the last few years, and also publishing the Global Investment Letter. I suppose whatever success I've had probably owes much to me trying to be as pragmatic as possible in terms of the development of my investment style. When I started in the business way back in the 1980s, I was a pure value investor. And that worked very well at that time because the global macro and monetary environment was pretty benign, and you had the luxury of being able to just concentrate on looking at individual stocks. But as the 1990s wore on and you had the collapse of the Soviet Union, the global geopolitical scene started to get more complicated. And then also, as the 90s wore on, with the advent of the internet and so on, there were major changes, not only to markets, but just in terms of day-to-day life, which, and one of the examples is just this meeting we're having over Zoom now. So over time, my my style started to evolve from being pure value to gradually now being largely global macro, because I think it's a reflection of the era that we're in. But when I say global macro, I should say that the pragmatic aspect of that is that I still incorporate a good dose of fundamental as well as technical considerations when I'm making my investment decisions, as well as the global macro side of things, um, and reading history and just trying to provide as broad a context as possible to make my decisions. And that, as I say, if there is a bit of a secret to whatever success I've had, it's probably been the ability to adapt my approach and grow as an investor over time.
Yeah, that's great. Sounds like you really want to be pretty proficient in a lot of the different areas that it takes to be a good investor. It's something you can't, if you just focus on one part of investing, then the market may sort of leave you behind when things change. So it sounds like that's what you've done.
I think that's a very good point, is that we don't have the luxury of being stubborn in our views as investors, and we have to respond to change. That's not always easy, and it's not always easy to do quickly, but it's essential over time. Otherwise we'd all still be owning newspaper stocks and so on. I mean, the internet is one example of a technological and social development that just transformed our world over the last 25 years.
Yeah, no doubt about it. Yeah, I mean, technology has been incredible. I grew up, I got my first cell phone when I was in 8th grade, and now kids are getting their phones when they're 3 or 4 years old. It's just amazing. I feel like they'll be the only generation that had like the transition period where half my life was no phone and half was with a phone. So I'm
Yes.
like, we'll be one of the last remaining later on generations to remember and tell my kids what it was like to not have a cell phone.
Yeah, it's amazing. Yeah, I know, and they'll just say, how did you survive without a cell phone? So
Yeah, I mean, even now it's like, wow, I really just actually had to look around and see things around me. Wow.
yeah.
So you were mentioning you were focused on value before and now macro global. What is like the difference? What are some of the main differences between, like, practically when you're doing value, looking at fundamentals versus macro global? Because
Yeah, well, global macro does look at fundamentals, but they tend to be factors that affect the broad market as opposed to individual securities. If you're just when I was a pure value investor, all I would do was look at the factors that affected directly, the specific company that I was looking at. But over time, I realized more and more that the single biggest influence on share prices is basically the direction of the broad market, and in turn, the broad market is driven by investor psychology and interest rates and geopolitical considerations. We saw last year, the effect that a virus coming out of China can have on markets and so on. So now I should also add too that over time, very quickly actually, I recognize the merits of not just focusing on our own domestic markets, but being more international in our investment outlook, because that provides better context for investors. So even if you were somebody that wanted to concentrate on stocks in the United States or Canada or Britain or whatever, the knowledge that you can accumulate by looking at what's going on in the rest of the world can help you make better decisions in your own country if you just want to restrict yourself to that. So because I've adopted an international view, and I've recognized that the direction of the broad market has the single biggest influence on individual securities, that prompted me to develop a broader global macro perspective. And certainly now, when you look at the financial crisis of 2008 and the unprecedented monetary stimulus, and then more recently last year, where you had both monetary and fiscal stimulus that was just off the charts, those are all global macro issues that will affect markets. And if it affects markets, it'll affect your individual securities as well.
Yeah, that's a really good point about the number one determinant of a stock's direction is being the market, because you didn't have to be all that selective after COVID hit last year to make money buying securities based on, like you said, the fiscal monetary stimulus. Everything basically got a lift. So you could have the best secular growth individual stock story that you ever heard of that you think is going to do amazing, but if the global market is crashing, you're going to be left not in a good spot, no matter how good that story was.
Well, last March was a good example of that. Whatever you owned went down in last March, and that's an example also of the effect, the importance of looking at the broad bigger picture. I was fortunate enough to recognize back last January that the virus in Wuhan, China could be a problem. And I started writing about it in the February issue. And then in the March 4th issue, I recommended to readers to drastically cut exposure to equities, because I could see that this virus, which at that time did not have a vaccine to combat it, was going to be a major global issue. And it was. So I was fortunate in that instance to be able to save our subscribers from experiencing the worst of the market decline. And that, that's nice in itself. But I think the bigger issue going forward is it does pay to take this larger perspective of things.
Yeah, I think that's great for people to be able to have some solid information about what's going on globally, because it is very easy to get stuck in what's going on domestically. And it does provide a lot of context for sure. I remember before March last year, just the eerie complacency that was going on. The market kept drifting up even as we started seeing cases around the world. And I didn't necessarily, I was nervous, but I wasn't really necessarily expecting something huge to happen, because I was also complacent. And I think a lot of people were complacent. But when you're really, I guess, like for you, when you're really focused in on what's going on globally, you have a different sort of perspective.
Well, that's true. And one of the things that helped me as well is that one of the things that I incorporate in my research and analysis is monitoring volatility. And it's a complex subject, but one of the things that I look at is very low levels of volatility, which tends to reflect investor complacency. And back last February, just before the market really started to sell off, the volatility index, which is called the VIX, for short, was at very, very low levels. And buying volatility when it's at very low levels has been a staple trade for me over the years. It's been one of my most profitable techniques. And that's because volatility has a very strong mean reverting tendency, which means that when you have periods of constricted volatility, that ultimately, and the timing is imprecise, but ultimately it gets resolved into a period of higher volatility. So you go back to a more normal average. And that was one of the things that prompted me to adopt a really bearish stance early last year, is that the complacency was just there before my eyes.
So to me, it seems like the way you sort of manage, at least maybe your positions, is perhaps you're looking at all different parts of what's going on to look under like as many stones as you can to find something that doesn't seem right, or something that does,
Well,
maybe
yeah,
there's.
well, that's right. I mean, investing is, to be a serious investor does requires a commitment, and it can be a bit, it can be complicated. But, on the other hand, I've also been doing this for a long time now. So, I've built up some experience and some knowledge. So that helps me as well in terms of perspective. Um, but I would encourage anybody, whether you manage your own money or have a good advisor manage it for you, to make an effort to develop a working knowledge of some of the key issues that's going on in the world, because it'll help you if you're managing your own money, and even if you're having it managed by someone else, it will help you also to be able to ask intelligent questions of your advisor, and to better appreciate what they're doing as well.
Yeah, for sure. And I think you probably do a good job of that, or do a good job of that. As I was reading through your letter, it's pretty thorough, and you covered a lot of ground. And I know I learned a lot from just reading that one you did from July.
Well, thanks. It's very kind of you.
Yeah, sure. And so some of the topics in there that I thought were particularly interesting was your view on inflation, because that is perhaps the most sort of polarizing view in the market right now, transitory or not. I know you had some interesting views on that. And I
Yeah,
also would like you to cover what you think is causing the inflation as well.
yeah. I think to answer the last part first, I think what's caused the inflation has been supply disruptions that has been caused by the COVID pandemic. And so when you're getting supply disruptions, that will create shortages, in various goods, which will put upward price pressure on whatever goods happen to be in short supply. That just happens to be the way markets work. If something gets scarce, the price tends to go up. I do think I'm in the camp right now, and my view is subject to change if the facts change. But right now, I'm of the view that the inflationary pressures are likely to be transitory. They're not likely to last. One of the reasons is I don't think that the supply disruptions are going to last indefinitely, and that I think that that issue will be addressed, so that the flow of goods and so on will return to normal. So the spot scarcity issue is not likely to be a factor as we move into the fall. The other
When
issue,
you say spot scarcity, you mean the current present
yeah,
demand
well,
for the supply.
yeah, like the inflation that we've seen has been concentrated just in pockets. For instance, used cars have shot up in price over the last few months because there's been a chip shortage associated with the manufacture of new cars.
Mm-hmm.
So the slower rollout of new cars being produced has raised the price of used cars. Now, as that chip shortage, ultimately gets resolved, you're going to see an easing of pressure on inflation, because used car prices are going to go down. The other thing that I might say as well is that a surprising chunk of the rise in inflation that we've had is associated with things like used cars. And if you're not looking to buy a car, your day-to-day inflation impact is relatively minor. I put a chart in that July issue you were mentioning that I got from the Cleveland Federal Reserve, and it made the point that if you delete the factors in the economy that the tangential factors in the economy that are producing the biggest inflation and the lowest inflation, the core inflation, the 90% of goods and services, are not exhibiting a very high level of inflation at all. I think the other thing to bear in mind, and this is my opinion, is that I think we're likely to see evidence of a slowing economy as we move into the fall. And if I'm correct in that, and I see some evidence to support that, if I'm correct in that, that in itself will help ease inflationary pressures by softening demand. And then lastly, another consideration as well is psychology. One thing that doesn't get talked about a lot, but I think deserves more attention, is the psychological aspect of inflation. It's not purely a monetary phenomenon at all. To my mind, it's often more a psychological one, in that if consumer psychology changes such that more and more people are expecting prices to rise in the future, or develop a lack of confidence that the government can manage the economy, people will begin buying things sooner rather than later to save money, rather than paying the higher prices they expect in the future. I guess it's another way of hoarding and so on. And I don't see evidence. I don't see an inflationary psychology really being evident in any of the major Western countries as yet. A good recent example over the last 5 years or whatever is what happened in Zimbabwe, which Zimbabwe had a hyperinflation, but that really had more to do with the fact that the government lost all credibility and people were just attempting to hoard goods and services because they were unsure, about the future. I don't think that we're, anywhere near that. So my expectation right now is that we're going to see inflationary pressures ease. Certainly, the bond market agrees with me. Interest rates have settled down quite a bit over the last month, and some of the economic numbers that have come out in the last few weeks in the U.S. are basically missing analyst targets. They're a bit softer than was expected. And lastly, unless the Biden administration decides to extend the direct fiscal stimulus past September, when that comes off, that's also going to serve to soften the economy. So all in all, I think it's transitory. People back in 2008 thought the stimulus associated with the financial crisis was going to produce inflation. I was one of them, and ultimately that did not occur. And so I suspect it's the same thing now.
Yeah, that's interesting. So I was reading in your letter that you might be expecting some market weakness in the second half. Now, I know I've never been successful in making calls like that personally. So I'd love to hear what are some of the reasons why you think, unless it's what you just said, that you think all of those things together could create some market weakness. But we've seen the market be able to pretty much shrug off almost anything that's been thrown its way. So, and I guess if inflation does ease, I mean, is that going to put as much pressure on the Federal Reserve to raise rates? And because I know that's one of the things that I was thinking could potentially cause market volatility tightening faster than expected. So what are your thoughts on all that?
Yeah, well, I think that if I'm correct about evidence building for a weakening economy, that will contribute as a potential catalyst for market weakness. the big reason why I think the probability of a correction is rising as we move in move through the second half is that investor optimism is way ahead of the economic reality. And sort of an analogy that I kind of use is investor optimism is, has this painting in their mind of such a rosy picture that you have investor optimism is like a train on one track, and economic reality, which is much more sobering, is on a parallel track, and they're going, side by side, but eventually those two tracks are going to cross, and that crossing of an optimism and reality is going to produce, to my mind, a good deal of volatility.
So how long do you think those tracks have been very separated? Because after the remarkable recovery last year, I was thinking myself, this cannot be sustainable. So did the track start widening then, and they've just been staying separated ever since then?
Yeah, I would say, certainly, back in January, February, there was clear evidence of market euphoria and a speculative environment. And even though I have this view of markets, I also caution everyone, as well as myself, that you can't predict these things with precision. As investors, we can't deal in certainties. We can only deal with the spectrum of probabilities. And my contention is, because that market valuations are excessive and investor optimism is excessive, at some point that's going to translate into a market correction, and that is perfectly normal in stock market history. I mean, the market has never gone up indefinitely. I mean, as you only have to look as recently as last March to see that markets can indeed decline. So what I am attempting to do is always gauge risk reward. And so I still have a good number of long positions in various markets around the world, which I talk about, which I talk about in the issue. And I still have those long positions as of today, because they have not triggered what I think is a sell signal. But at the same time, I have set some protective sell prices that I'm going to use to allow me to preserve most of the gains that I've accrued in the marketplace if the trend changes. And I've also instituted sort of a hedging strategy for my portfolio to actually protect the portfolio, and also perhaps make some money if the market declines. I don't know when that's going to occur. I just know that from my own experience over the years, the period from August through October has seen, a good many bouts of market volatility over the years. So I think the odds are growing that we might see some more market weakness, but at the same time we might not either. In which case I'll just hold my long positions, and until I have reason to change them.
Right. So yeah, I noticed how you mentioned that you're making money while you're as bearish as you've been in a while. So that's great. 'Cause I know a lot of people who get so convinced of one way or the other will put all their eggs in one basket. Maybe they were, maybe it was last summer, and they're like, wow, the market cannot go any higher. I'm just going to start shorting the market straight up and have barely any protection. You could have absolutely had, your butt handed to you in that case. So what you're doing is you're sort of just gauging the risk reward, and since timing is never a good thing, you're letting what you have working continue to work until it doesn't work. Is that kind of what you're saying?
Well, yes, but I mean, I think it's also important that to say that the market's impossible to predict, I don't think is right. I think that if you weigh risk and reward, that can go a long way to generating decent returns over time. I'm not a believer of in the efficient market hypothesis that the market is totally random and is totally unpredictable. I don't know any professional investor that really believes in that. I mean, I was taught that when I went to business school, but that seemed unlikely when I was a kid, and it seems even more unlikely now. But at the same time, sometimes these things take longer to transpire than one would think. So inevitably, we're going to get a sharp market correction. I just don't know exactly when it's going to be, but I've tried to posture my investment strategy accordingly to take advantage of it when it does occur. And if the market wants to go straight up for 5 years, well, that's fine too. I'm still long until I have reason not to be.
Right. Yeah. And that was the point I was making, was that you're not ever going to be all your eggs in one basket. Because if your subscribers or anyone, that's risky, because you admit you are aware that things might not happen when you expect them to happen. Because we've seen market euphoria last for a very long time. I mean, I'm young, so I still have lots of market experience to gain. But I've just found this completely fascinating, because I remember being extremely bearish last summer when the market kept making new highs. And I had a little bit of egg on my face with some of the things I was doing. I was just doing hedging, but still it was like, why are you doing all this hedging when the market just keeps going up? I'm like, well, I don't know when it's going to go down, but the economy has just absolutely tanked, and this coronavirus thing is so much uncertainty. Like, I think it's reasonable to have some protection in place, but the market has a way.
I don't think what you did was foolish at all. I think at that time, a lot was up in the air regarding the pandemic, and the vaccines hadn't really made an appearance yet. And so, sometimes you can do the right thing in the market and still end up losing money. So, you can have a well thought out plan, but the market might decide to go in a different way, and that's because the market is just a collection of people, and psychology drives the market, and crowds of people will end up doing things that a sane individual would never contemplate. So that's why you have markets going to the stratosphere, and also why you have market crashes and so on. It's because of the presence of crowd psychology and affecting the market. So at that time, Dave, I don't think your thoughts were foolish at all. It just didn't happen to work out that way. But as long as you've got a cogent reason for your decisions, and you're always double check yourself and be prepared to admit you're wrong. I think that's the best any of us can do as investors.
Yeah, well, I appreciate that, for sure. So speaking of psychology, where would you say the market psychology is, like, right now? Like, where are even professional investors, where are their heads at? Because we have the COVID strain getting worse and worse, and now I acknowledge also that so far the death rates are several fold below where they were at a similar new case rate last year. But I mean, where is investor psychology? Because this market seems to be sort of just floating on obviously light summer volume, and it feels like you kind of get that gut feeling that it's weakening just from bird's eye view, from the breadth at least. But so where do you think market sentiment is right now?
Well, you're absolutely right. Market breadth is very, very narrow, and that historically has been a troubling sign for markets. Some of I look at a lot of different things, but some of the things that cause me to believe that people are becoming over optimistic is that margin debt is at all-time highs. And even more noteworthy than that is that the growth in margin debt has been enormous since the market drop of last March. And so that type of rapid increase in margin debt is the best evidence that people are extremely optimistic, because with margin debt, they're not just saying they're optimistic, they're putting their money where their mouth is. There are some things about the COVID pandemic to be very optimistic about. The vaccines, are very effective, and they do appear to be effective for the most part, like 99% with the latest Delta variant. There's an issue with people that aren't vaccinated. They're putting themselves and others at risk, frankly. My major concern is not necessarily the Delta variant, although, as I say, because it's so easily spread, the unvaccinated portion of the world population remains at risk. My concern is that if we don't get a good percentage of the world's population vaccinated, we're just going to give this virus more and more opportunity to evolve into something that can get around the current vaccines that we have. And so it's not the Delta variant, it's whatever comes after it, where the epsilon or whatever the next one is going to be called. That's my concern. And this virus has proven to be very adept at evolving into more virulent strains. To my mind, what I'm praying for is that we can get most of the world's population vaccinated. That were at one time, smallpox was like a major scourge in the world, and vaccination basically eliminated smallpox from the world scene. It was, smallpox was killing millions and millions of people. So, I mean, there is historic precedent for the usefulness of vaccines and so on. So that's my concern, and that is not priced into the market at all. Is any kind of a major upsurge in the pandemic, or a requirement to start shutting aspects of the economy down again. That's not priced into any stock market anywhere right now. I think everyone is quite optimistic because of the vaccines, and I certainly hope that proves to be correct. But as an investor, I have to not only sort of pay attention to what makes me feel good, but also pay attention to things that can be very concerning, and that's concerning. But even without that, the what I think is excessive complacency in the market is typically precedes market pullbacks. I mean, that is just a sort of a staple of stock market history. And the volatility index, which I mentioned earlier in our talk, is back down at relatively low levels, which confirms my view about investor complacency. So all of that gives me pause. The prospect of a weaker economy and so on doesn't, and if we have a market correction, it could be painful, but it's not going to be the end of the world either. My attitude is, if I'm properly postured, is we have the pull. My sell prices will get triggered. I'll get sold out of my long positions, and I'll take my profits. My hedge will make me a bit of money, and then when I think we've got the corrections over, I'll start poking around, looking for new investment opportunities. And as we saw last March, some of the best opportunities appear after we've had a sharp market break.
Yeah, for sure. That got me thinking. I wanted to ask you, how do you think just from a theoretical perspective, how does market complacency get to such levels like this, especially considering the turmoil that we went through in the economy? You would think that would be more of a wake up call. Obviously, it was in the moment when it went down, but how does market psychology work in such a way that we can then go for so long at such complacent levels, while there's still all of these risks floating around? Like, how do we get to a point where nobody's really paying attention to them in quite the way that you are?
Yeah, well, I mean, whatever knowledge I may have was hard won over a period of quite a few years. So
Right.
I didn't come out of the box sort of with this experience. I think basically one thing to remember is markets are driven by human psychology, and human beings are very fallible creatures. And speaking as a human being, I certainly know that to be true. And one of the characteristics of human psychology is what they call recency bias. What basically people will tend to extrapolate what's happened in the recent past. So if the markets start acting very positively for a while, people will start to assume that that's going to last indefinitely. And the longer it goes on, the more confirmed people tend to be in their bias that way. Just like, as you were saying last, people after March, there are a lot of people, were shell shocked and were just bearish, and took a while to sort of adjust their thinking, because their recent history was that the market had declined. We're now at the flip side of that, and people, because they've had now over a year of very positive markets, many people just assume that it's going to continue. And when that gets to extreme levels, and I would suggest that we're kind of at extreme levels now, that raises the prospect of a market correction, because human psychology also can be very fickle, and something, it could be small, it could be big, will trigger a change in market psychology. And then once the market starts selling off, then more and more people will start to capitulate and say, oh geez, what was I thinking, and start moving down. And as I say, I mean, human psychology is why we have a history in the markets of great bull markets and market crashes and so on. These volatile events that we see in markets are purely a function of crowd thinking, group psychology, and that's always going to drive markets as long as people are involved anyway.
Yeah, and I guess lots of the average person you meet on the street who's saying, hey, what stocks have you been buying recently, they aren't necessarily using a whole lot of research or fundamental stock research thinking to make their decisions. It might just be what their brother or sister told them to buy. And
well, I mean, that you make a very good point, as that there are a lot of very new investors that have come into the market over the last year, retail investors, people using various trading apps like Robinhood and so on. And, their lack of experience, it makes them more susceptible to emotional response to markets. And I think, the renewed interest by retail investors in the stock market is probably going to make the markets, as we move through this decade, more volatile than they have been. The last decade was unusually low in terms of market volatility. And because one of my observations is that volatility tends to be mean reverting, the low volatility that we saw, in the 10 years between 2010 and 2019 is likely not going to last, and is one of the reasons why I think the 2020s are going to be a challenging set of years for investors. Not just because volatility was muted in the last decade, but because of the geopolitical and monetary situation that we've inherited globally. I mean, debt levels are off the charts throughout the world's financial system, and that ultimately is going to create another major financial crisis. Although I don't think it's probably going to happen for some years yet.
Yeah, interesting. So before we wrap, I want to ask a couple more questions about Robinhood and the retail trader. So the retail trader or investor, since they're less informed and not acting always on complete or the best available information, they can certainly help make the swings in the sells go a little higher or lower than in an otherwise purely institutional market, let's say, because they're going to help exacerbate things on both sides.
Yeah, I mean, I think GameStop is a good example of that, isn't it?
Exactly.
Yeah.
Yeah. So I wanted to ask, how do you think history will look back, let's say 5 years from now, on this whole meme stock thing that's going on? Do you think, because, all of these people on the Reddit board say, oh, it's no longer about fundamentals, which makes my eyes bleed to read that, but
yes,
it's more about the flow of, or the volume of tweets about a certain stock. And they think that's going to be how they make money going forward in the stock market. To me, I think.
well, I obviously I'm a little bit older than they are, and so I have so perhaps my comments are a reflection of my age, but I see it as more as a as more of a passing phase for these investors, and I think that the guys that are, or girls that are on Robinhood and Reddit right now, the serious ones are going to learn more about investing and the markets and so on, and they're going to evolve into sort of taking a bit more sophisticated view, and the people that don't are ultimately going to get sort of washed out of the market. It's there are some basic principles that even though times may change, still make sense. Still sort of make sense and recognize and represent value. So I think in 5 years it'll be something else. It might not be sort of GameStop and Reddit, but everything has its fashion and fad, so it'll be something else. But I don't think it'll be the same Reddit guys driving the market.
Right. And then something I've been thinking about recently is, when I first heard of Robinhood, I thought, okay, this is great. Their mission is to democratize access to the market. But with all their social engineering and their sort of way they try and addict people to trading more, I wonder if it actually has been a benefit or actually a detraction. So,
well, yeah, you know what?
For instance, they throw confetti down when you make a trade, like to reward you.
You see that? Yeah, well, yeah, I know. I see. You will not be shocked to know that I'm not on Robinhood. But
no, I'm not shocked at all.
No, you know what? If they're not, if they're not encouraging people to learn more about investing, they're doing a disservice to the users. Investing is not a video game that you can play on your iPhone or whatever. And the other thing to remember too is this Robinhood app isn't really free. They're selling the users trading information to hedge funds and institutions so that those big institutions can end up getting advantages in trading. So the information that that they're surrendering in exchange for commission-free trading isn't really free. There is a cost. It's difficult to quantify, but there's a cost there because that information is being used against them in the marketplace by big institutions. My own, my thought is, investing is a difficult I almost say art to practice, and it requires a lot of education. I'm still, I'm still learning almost every day, and unless something is encouraging new investors to learn more, I don't think it's doing them a service.
Yeah, that's a good point. Yeah, I figured you might have some pretty sane wisdom to speak on that. Maybe for anyone listening. So just about done here, but I did want to ask you. So our audience would typically be pre-retirees, people that are serious investors that are looking out into their retirement. So what are some possible thoughts or ideas or risks maybe that they should be aware of? People that are maybe in 5 years looking to retire and they want to have their assets be safe, obviously as safe as can be throughout retirement, because I know retiring when the market's at highs can often lead to very bad results when maybe you have 2 years in a row of market drawdown and next thing you know, a third of your assets have been wiped out 2 years into retirement.
Yeah, that's a very good point you make, and I think that because I think the 2020s are likely to be volatile and challenging for investors, the best thing that I can do is encourage people to take an interest in the markets themselves, to get a sense of their own risk tolerance, and to have a sense of some of the key factors that are affecting their investments, including interest rates and so on. Once again, as I said earlier, that's certainly critical if they're attempting to manage their own finances. But it's also important if they decide to, if they're lucky enough to find a good advisor, that it's always a good idea to know enough about something to be able to ask intelligent questions so you can understand what's going on. It's like with our health, right? I mean, we all have physicians, but frankly, it's a good idea also to know about some key issues affecting our health, that we can ask our doctors, intelligent questions so that we know what's going on in the state of our health. I don't think, I'm not a big believer in passive investing, just like I'm not a big believer in being passive in anything else, whether it's our health or relationships or whatever. So my encouragement would be to learn as much as you can, as much as given your inclination to do so and time and so on. But I think it will be time that's well rewarded, not only in terms of potentially financially, but just in sort of generating a bit of a peace of mind by having an idea of what's happening. And certainly, that's part of the mission of the Global Investment Letter, is just to provide a perspective for the subscribers to make their own investment decisions. And that, my attitude is, you can just disagree with me if you want, but at least I'm going to give you something to think about, and I'm going to perhaps present some information to you that you wouldn't, have come across otherwise. So, that's I couldn't stress that enough, is just take an interest and read.
Yeah, I think that's great advice. Why don't you tell the people listening real quick how they can subscribe to your investment letter, and just remind them, anything you want to say about it?
Yeah, okay. Well, the Global Investment Letter covers, it's basically my own trading journal or trading diary, in that what I do is I present sort of my analysis of markets, as well as talk about the investment positions that I have and how I'm managing those positions. So I talk about all the major equity markets and the currency and commodity markets, and I talk about U.S. Treasuries and stuff, and just anything else that I think will affect investors' fortunes. I talk about gold and oil and all of that. You can access some free sample issues on our website. The website's globalinvestmentletter.com, and you just click on the sample issues tab, and you leave your name and email address, and you'll get access to, I think, 7 or 8 free sample issues. And by doing that, you also get put on a weekly email that I send out on just sort of weekly investment thoughts. And if you don't want to receive that weekly email, you can unsubscribe anytime. And then there's the paid version of the Global Investment Letter, which is put out monthly, around between the 3rd and the 5th of the month. And that is it.
Well, awesome. I do recommend people subscribe at least to the weekly letter. I'd subscribed, and I look forward to reading some more from you. And Jonathan, it was great to have you on. I thought that was an excellent conversation. And
the pleasure was all mine. I really enjoyed it.
All right. Thank you so much. Take it easy.
Bye-bye.